Is one of the best investments you can make for your future. In this video, we are going to look at different asset classes to see which one has performed the best. We're not going to look at hard assets such as real estate because it varies drastically depending on when you bought, where you bought, and what type of property you bought. But in this video, we will include a class of securities known as real estate investment trusts, which is essentially an ETF, a stock that you can buy to invest in real estate. So without further ado, let's get into what is one of the best investments you can make for your future. To do this, we're going to head to a website called Portfolio Visualizer. And we're going to look at the performance of different asset classes over the last 30 years. So our start year is going to be 1992 because we're going to go 30 years back. We could go all the way back to the 70s, but we're not going to do that. And we are going to include year to date, so that's going to bring us up to today, which is June 24th of 2023. And then our initial amount is, we're going to say that we invested $10,000 back in 1992. With our cash flows, we want to act like this is a true investment on the way that we would typically invest. So we are going to have cash flows and we are going to contribute a fixed amount. Now the contribution amount will be different for everybody. How much can you afford to invest in a given month? For us, we're going to say $500 every single month, which would lead to $6,000 a year, which is just under the max contribution for a Roth IRA, which everyone should be trying to max out currently. We are going to adjust this for inflation, and the contribution frequency is going to be monthly, and we are going to rebalance annually. The leverage amount, we're not going to do any, and the benchmark, we don't need to include. So asset class number one, we are going to do US stock market, which would be similar to investing in Vanguard's total market fund, VTI. That's going to give you exposure to the thousands and thousands of stocks that are listed in the US stock exchanges. The second asset class we're going to do is US large cap, which would be similar to investing in Vanguard's VOO, which is going to follow the S&P 500, which is US large cap stocks. And then the third asset class, we're just going to go to mid cap. Now, for portfolio one, we're going to have 100% allocation to the US stock market. For portfolio two, we're going to do US large cap. And for portfolio three, we're going to do US mid cap. And now I'm going to change this to total market, large cap, and mid cap. We can only do 3 portfolios at a time, so we are going to have to repeat this process. So now we're going to go to analyze portfolios. And now if we scroll down, we're going to see what our returns would be. And we look at our final balance, US mid-cap has actually had the highest balance at $1.7 million compared to large cap at $1.5 million and total market at $1.5 million. The best year was 40% for mid-cap, 37% for large cap, and 35% for total market. The worst year was negative 37% for total market and large cap, and negative 41.8% for mid cap. The max drawdown was negative 54% for mid cap, and negative 51% for large cap and total market. So what this shows us is that mid cap is the best performer, but it also has the max drawdown. Now this is where it gets tricky. Which one is the better asset class to invest in? Is it better to have $1.52 million with a max drawdown of negative 50% or $1.7 million with a max drawdown of negative 54%? Now let's keep these numbers in mind and we'll roll with saying that large cap is the best investment out of the 3, and we'll compare large cap against some other asset classes. So asset number 1, we're going to move to large cap. Asset number 2, we're going to make small cap. And asset number 3, we're going to make micro cap. Now the evidence here is clear which is the best winner. It's large cap because the final balance between the 3 are very similar, with small cap providing the least amount of returns with a total final balance of $1.4 million. But where the large cap shines is your max drawdown of negative 50% compared to microcap at negative 56%. So let's dive into this a little bit further before we look at other asset classes outside of just stocks. So I want to change US small cap to US large cap growth, and then the third one to US large cap value. So we're going to call this large cap growth, large cap value. And let's look at the results. So here we are, as expected. The large cap, overall large cap, is right in the middle when it comes to final balance of $1.5 million, where large cap growth is $1.8 million. And the max drawdown, they are kind of similar. But what is surprising is that the largest drawdown actually came from large cap value at negative 55%. This is surprising to me because you would think that value stocks would be safer and you would experience less of a drawdown during bad times, when actually just investing in the overall market is better suited if you're really concerned about drawdown. But large cap growth with that additional potential returns at the end is also a really good option. And that's why me personally, I have 60% of my retirement account in large cap, 30% in large cap growth, and 10% in bonds. Because my preference, as we can see from this portfolio visualizer, is to get some of that growth at not a huge risk with that large cap growth, while also being invested in large cap companies, essentially tracking the S&P 500, which is everyone's benchmark. And doing this time and time again, continuously adding to your account and holding through the good and bad can leave you with a huge final balance. Initial balance of $10,000, and in 30 years, you're looking at $1.5 million. And if you do this in a Roth IRA, this is all going to be tax-free. So you can withdraw all of this money at retirement and not pay an additional penny in taxes. So we have US large cap, and now let's take a look at stocks abroad. So let's include emerging markets as portfolio number 2. And then let's include global ex-US stock market. And let's run the results. All right, here, US large cap blows the other alternatives out of the water. Now here we're not going back as far because we have to go back to 1995. That's as far as the data will allow us to go for some of these other funds. But US large cap, going back to 1995, has a final balance of $1.1 million compared to around $500,000 for emerging markets and global ex-US. So you're having much more returns with US large cap, and your drawdown is far less because EM has a drawdown of close to 63%. No bueno. Horrible results, and you're experiencing much more volatility. Not a huge fan of that. So let's look at some other alternatives. I think the next logical step is to take a look at bonds to see if we can actually get some returns and what our max drawdown is compared to US large cap. So I want to take a look at total US bond market. And I also want to take a look at high yield corporate bonds. So this is going to be total bond market US, and then this is going to be high yield corporate bonds like HYG. All right, here are results, and this is where it can get tough. The total bond marker, sorry for the typo, has a final balance of $500,000, but a drawdown that is far less at negative 17%. HYG has a pretty good return at $750,000 with a drawdown of negative 28.9%. Large cap, if you're okay stomaching that max drawdown, and when your account gets slashed in half, you do not sell and you continue to buy, is still the better way to go. But if you're looking between US bonds and high yield corporate debt, there's a case to be made that HYG or high yield corporate debt is better than the US total bond market. You have more drawdown, a negative 28%, but you also have a higher CAGR. The decision has to be made if that's what you want to do. But there is no clear winner between US total bond market and high yield corporate debt, in my personal opinion. Now let's take a look at some other asset classes. We want to take a look at real estate investment trusts, and we also want to take a look at gold to see how they perform. And let's analyze the results. All right, the real estate investment trust provides a lower final balance, but a higher max drawdown. No good. Probably better just to invest in the S&P 500. Now this data goes back to 1994, so still a lot of good data here. Gold, also not that good. Final balance of $765,000 expected. You're not going to make more money investing in gold than the stock market, but you should experience less drawdown. How does that stack up against US large cap? Negative 43% minus compared to negative 51%. Not that attractive in my personal opinion. Large cap with that extra growth and not that big of a difference with the max drawdown, worth it in my personal opinion. So let's change gold and let's take a look at precious metals. And let's change the real estate investment trust and take a look at commodities. Now this data doesn't go back as far. We're going back to 2007, so not a ton of data. And we can see that large cap, obviously the better grower, more than double precious metals, and less max drawdown. Precious metals, negative 76%. Commodities, almost negative 89%. Very cyclical, experiencing huge drawdowns, not a safe investment, and providing less returns. No bueno. All right, so US large cap or maybe that US mid cap, those have been the best performers with similar max drawdowns. Let's take a look at a portfolio that is 60-40, 60% stocks and 40% bonds, and see how that stacks up. Just investing in US large cap. And then let's look at the portfolio that I personally have. So we'll keep portfolio 1 the same because that's what we're going to compare the other 2 portfolios to, but we need to add different asset classes. We need to have total US bond market, and we need to have US large cap growth, and we need to have US stock market. So your traditional 60-40 is going to be 60% US stock market, and the allocation of that 60% might be different. You might have some international stocks out there, some emerging markets, but we're just going to assume it's 60% allocation to the total US stock market. And then your second weighting, your 40% is going to be in the bond market. How it's invested in the bond market is going to be different per portfolio, but we're just going to assume it's in the total US bond market. And then my portfolio is 60% US large cap, 30% US large cap growth, and 10% US bond market. Now let's analyze the results. So if we look at large cap, $1.5 million with a max drawdown, a negative 51%. The 60-40 is $1 million with a max drawdown of negative 30%. So that 40% allocation to bonds is helping with exposure, and your worst year is negative 20%. That 90-10 with 30% allocated into large cap growth has a final balance of $1.5 million. So it's the same essentially as large cap, even though we have 10% in bonds and our max drawdown is about 6% less, and our worst year is less than US large cap, but it is worse than that 60-40. So the decision has to be made if 50% additional growth from that 60-40 allocation is worth the additional 13% in your worst year or 14% in your max drawdown. I think the decision between large cap and this mix makes sense because you are getting essentially the same final balance, but you're experiencing less drawdown and less volatility. So this obviously is better than that. There's no comparison. The question then is, and this is based on personal preference, is if that 60-40 is better than the 90-10. And in my personal opinion, if you're investing for the long term, you shouldn't really be afraid or too afraid of your max drawdown. You should expect it, and when it comes, you should take advantage of it. And that's where you can actually make a lot of money if you were to put more money during those tough times. In my personal opinion, and this is not financial advice, but I think the best asset class to invest in for the long term is going to be a mixture of large cap with some bond allocation. And this is not me coming up with this idea. This is Warren Buffett and what he is doing with his personal money after he passes away. He has directed his trust to put 90% in the S&P 500 and 10% in US bonds. I've included 30% in growth because I'm willing to take on a little bit more risk to try to get that final balance just like the large cap. Because when I look at US large cap growth compared to US large cap, that additional risk is minimal, but the returns are optimal. Let me know what you think is the best asset class to invest in for the long term. And these are only for securities. It's obviously good to have exposure to hard assets like real estate properties and diversify in that as well. So please consider joining the private Discord server. A link is in the video description and in the pinned comment. It's super cheap at $5 a month. We go over investing and trading strategies every single day. I post all of my trades and investments live as I do them, and I'm here to help you. And it's a community of other like-minded investors and traders whose goal is to make money. Outside of that, I thank you so much for your time, and I'll see you on the next video. This is We Are Investing, and I'm out. See ya.